Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer. The show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. We are back with another episode of the Coffee Break Sessions. Today I'm here again with Christin Cifaldi. Christin, welcome back to the show.
Great to be back, John.
So what is algorithmic trading?
Algorithmic trading is becoming extremely popular, and that's where computer programs are used to execute trades automatically based on predefined criteria such as price, volume, or timing. It's like having a digital assistant that trades on your behalf. So what we're seeing at large financial institutions, mutual fund managers, companies that manage index funds is we're still having our portfolio managers perform analysis, and then that's being outsourced to machine learning and AI models who will watch the market for what the analysts and portfolio managers have predicted is a good time to sell, buy those to integrate them into portfolios. These programs can be used to execute extremely large trades. So this is not generally something that an individual is going to have in their pocket, although I'm sure there's probably apps and things out there that will look and automatically execute on anything that you enter as criteria. We're talking more about large market moving trades.
That's interesting. Sounds kind of scary for
It is.
You're competing with investing with robots.
Yeah, it is a little.
So how does this differ from traditional stock trading?
So traditional stock trading is relying on human decision making, where algorithmic trading is using algorithms that have been created by humans to analyze data and execute the trades faster and efficiently. And when we're talking AI and machine learning being incorporated here, sometimes these are being set loose on their own. And that's where we need to be careful with how we're programming them and how we're looking at them and making sure that these things are being monitored by the humans who are knowing where their portfolio and the interests are going. The plus side is that once you have algorithmic trading set up, it can minimize human errors and emotional bias. So if you're creating this algorithm and you want to optimize your portfolio, you're putting in your specific research and your parameters, and then the machine learning, the AI model is going to take that over and just do it for you. And that's why you want to be watching it rather than tinkering with it after you've set it up. We also have to watch out, though, because there's definitely been multiple studies that have shown that the algorithms that people create, they're still created by people, and your emotional and social bias does get put into that, whether you think it does or doesn't. So that's going to be present. It's something we can't stop doing as humans. And then that's other people can come in and review it. Maybe you have such a large organization that you have other folks scanning it. Like this is something that your Metas and your not Twitter anymore, your X, they're going to have a team of people trying to remove these biases, looking at the data. Like facial recognition they discovered was very biased, and they've been working on improving that. So as we move forward into this new age of AI, I think we'll see that these algorithms get cleaned up a bit as we have different people helping to program them and to scan them.
Interesting. And what are the basic components of an algorithm used in trading?
So we're going to take our key components that are determined by the portfolio managers, like market prices, and they're going to set up decision-making logic, rules, models that they're using to identify investment opportunities. And then there will be programmed in execution mechanisms to place trades. So you see this data pop up at this time, just automatically execute the trade. We don't have to think about it. And then there's also the ability to include risk management protocols. And if there's not a risk management protocol in place in the algorithm, that's not a safe way to invest. So I would hope that everybody using algorithmic trading has at least some sort of risk model that they've incorporated into that.
They pull the slider all the way to most risk, most reward. how do algorithms make decisions in algorithmic trading?
Then once you set your algorithm loose on the world, it's going to process real-time data and it's going to apply the mathematical models that it's built off of to identify profitable opportunities. These algorithms may detect when a stock is undervalued based on historical data and will then execute a buy order on your behalf.
Can you go into speed real quick? How important is speed?
Yes. So the whole point of having an algorithm do your trading is to get it done as quick as possible to help take advantage of those small market fluctuations. So a good example of this is hedging, currency hedging. If your algorithm can identify an opportunity for hedging quicker than another algorithm, you can catch that right before the next one goes off and you can make money on that arbitrage. It just depends on your investment goals. So if you're working with these things, milliseconds can make a difference because the size of the trades they're making is so large. We're talking where, earning 1 or 2 cents on a currency swap is going to make a big difference. So speed is the name of the game in algorithmic trading. It's why they've been developed. And some of the algorithms are very high frequency and they rely on the ability to do ultra fast execution. And as I mentioned, that's how they capitalize on those fleeting opportunities that are available just for milliseconds before the next algorithm is going to try and take advantage of it.
So the fastest machine will win.
Yes. Yep. If you keep programming them faster and faster.
Cool. Well, thanks. And to our listeners, be sure to tune back every first and third Thursday of the month for another episode of the Coffee Break Session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.